What is a three-fund portfolio? A three-fund portfolio is a simple investment strategy to maximize your portfolio's return. The three-fund portfolio is renowned for its simplicity, tax efficiency, diversification, and low cost. Perhaps the simplest strategy is just to put all your money in a target date fund. It is mathematically certain to outperform most investors, the three-fund portfolio, and probably the target date fund as well. If you want a little bit more elaborate of a setup than just plowing all your money into a target date fund, the three-fund portfolio is just one step up in complexity. The three-fund portfolio is going to be comprised of three pieces that should be all low cost and representative of the entire market in that segment. So number one is domestic stocks, usually a total stock market index fund. All the brokerages have some type of total market index fund that's low cost. It usually is less than 0.1% in the expense ratio. The second component is international stocks. International stocks provide diversification from U.S. stocks. Sometimes international stocks outperform American stocks. So you do want some diversification into international markets. You don't want just all S&P 500 or all American stocks. And the third component is domestic bonds. Bonds are low risk, low reward. They are a relatively safe investment. As you approach retirement, you will want to increase your exposure to bonds. The advantages of the three-fund portfolio is that it's a compromise between investing in general is a compromise between simplicity and control, and this is really the three-fund portfolio is almost the perfect compromise between the simplicity and control. It offers a middle ground between the simplicity of a target date fund, which is probably the easiest strategy, just put all your money in a target date fund, and the complexity and time-consuming work of investing in individual stocks. The three-fund portfolio prioritizes diversification, which is a fundamental concept of investing. Your investing horizon would determine the allocation of your portfolio. The more time you have to invest, the more weight you would put into stocks. So we can look at some sample three-fund portfolios. So an 80-20 three-fund portfolio will put 80% of the weight in the stock market. 64% of that will be in the total stock market or the American stock market. 20% will be in the bond market, and then 16% will be in the international stock market. So you take the 16 in international, the 64 in the domestic, and you get 80% in stocks, and then you have 20% in bonds. And this is probably the most aggressive of the three-fund portfolios I'll show you. If we look at a 60-40 three-fund portfolio, you have 60% allocation in stocks, 40% in bonds, 48% is in domestic stocks, or this visual shows it as total stock market. You have 12% in international stocks, and if you look at that ratio, it's 1-4, 1 part international, 4 parts domestic or total stock market. And that was the case with the previous 80-20 portfolio I showed you. So these portfolios are going 1 part international, 4 parts domestic, and then you have 40% in the total bond market. So you have 40% exposure to bonds, and this is more conservative, more defensive than the 80-20 portfolio. This third visual is a equal weights portfolio. So you have basically a third in total market stocks or domestic stocks. You have a third in bonds, and then you have a third in international. This is kind of a strange one because you have so much exposure to the bond market, but then you have so much exposure to the international stock market. So I don't know that I like this because it's neither very defensive or very aggressive. It's like it's almost the worst of everything. So I really don't like this one. It raises a lot of questions. If we look at this one, it's 40-60, so 60% bonds, and then you have 40% stocks, and again you have that 1 part international, 4 parts domestic or total stock market. So we're getting very conservative here. Now this last one is 20-80, so you have 80% in the bond market, and then 20% in stocks. So this is extremely conservative. So this would be, when you're getting close to retirement, you have all your, you're looking at capital preservation. You want to preserve your dollars. You don't want to deal with market fluctuations, but this still has some exposure to the stock market and even the international stock market. So this is a very conservative play. So if we look at Charles Schwab, if you have Charles Schwab, you can do a 3-fund portfolio using the Schwab Total Stock Market Index, ticker SWTSX, the Schwab International Index, SWISX, and then the Schwab US Aggregate Bond Index Fund, ticker SWAGX. If you have Fidelity, you can construct the 3-fund portfolio using Fidelity Zero Total Market Index Fund, ticker FZROX, or the Fidelity Total Market Index Fund, ticker FSKAX. For the international piece in Fidelity, you could use Fidelity Zero International Index Fund, ticker FZILX, or Fidelity Total International Index Fund, ticker FTIHX. And then for the bond part, it would be Fidelity US Bond Index, FXNAX is the ticker. So those are all mutual funds I just gave you, the Charles Schwab and the Fidelity 3-fund portfolios. You can do this with ETFs. And so like the BlackRock iShares, you can use iShares Core S&P Total Market ETF, ticker ITOT, iShares Core MSCI Total International Stock ETF, ticker IXUS, iShares Core Total US Bond Market ETF, ticker AGG. For Vanguard, you can use Vanguard Total Stock Index, ticker VTI, Vanguard Total International Stock ETF, ticker VXUS, Vanguard Total Bond Market ETF, ticker BND. There should be some links, like a works cited somewhere in this video, or like in the description. If not, go to a website called bogleheads.org, BOGLEHEADS, Boggle.